Silver just dropped 22% in 2 hours. That's a $17 move straight down from the highs to below $74 an ounce, and it happened fast enough that most traders didn't even have time to react. Anyone who has been trading long enough knows that this was forced. To put it in context, this is the most violent hourly silver candle in years, worse than anything we saw last Friday. Let's just talk about the timing of it. This hit right after the Globex open, when liquidity is thin and there aren't enough buyers standing there to absorb size. That's how you get air pockets and how prices fall into a vacuum. Here's what actually happened, in my opinion. Silver had rallied parabolically earlier. A lot of that move was driven by leveraged longs in CME and COMEX futures. Futures allow massive leverage. When volatility spikes, exchanges simply raise margin requirements. And that's exactly what we've been dealing with. CME already shifted to a fixed percentage of notional margin policy in mid-January, and last week alone they hiked performance bonds twice, lifting margin requirements by roughly 60%. No rate hike today, no new macro shock, just margin math catching up with leverage. When those margin calls hit, traders don't have the luxury of deciding to sell. They're forced to sell, at market value, immediately. That's how paper silver can drop 10 to 20% in minutes. And that's what this was. A margin call, badly timed, dumped into low liquidity. You can see the same thing across risk assets. Bitcoin is down over 8% today and still looks like it wants lower, potentially toward the $50K area. Silver is getting hit alongside it, but structurally, silver is in a very different position. Now let's talk about the technical damage. Silver dropped straight to the 50-day moving average, a full fishing line move down. I'm still looking for a daily close above it, which would give us a higher low. If that holds, this move becomes a violent correction, not a trend break. If it fails, the next real downside reference is the 100-day MA, which is still roughly $14 lower. That's the risk zone. Until the diagonal resistance is decisively broken and held, there's still room for chop. But once silver closes cleanly above that resistance, the odds favor a sharp upside continuation and eventual higher highs. We briefly broke the uptrend resistance this morning and immediately got slammed back down. That tells you someone is actively defending levels. Expect attempts to pin price in the $80 to $90 range through February. Meanwhile, overnight in Shanghai, 1,396,553 contracts traded on the April 2026 silver futures alone. That's equivalent to 674 million ounces of silver. Total morning volume across contracts was roughly 1.34 billion ounces. That's almost double the entire annual global silver mine supply, traded in a single morning. Obviously, nothing about this was normal. Normal sellers scale out, distressed sellers dump at market. You don't naked short 674 million ounces in one contract month unless something is breaking. This has all the signatures of a forced liquidation or a trapped entity defending a margin call. Someone big is under pressure. Now yes, SHFI silver futures are down about 14%, and that is significant. But even after that drop, Shanghai pricing remains well above COMEX on an equivalent basis. The premium survived a global leverage flush. And more importantly, physical markets did not break. Physical premiums did not disappear. Inventories did not rise. Delivery did not seize up. Shanghai futures are still leveraged instruments. They are not the same thing as SGE physical or OTC spot metal. In stress events, futures everywhere gap together. If this were true global rejection of silver, Shanghai would lead the collapse. Premiums would vanish. Inventories would spike. That didn't happen. What we're seeing is synchronized deleveraging, two different systems under stress at the same time. This also highlights the broader geopolitical tension. The U.S. controls hydrocarbons. China controls metals and rare earths. There's an ongoing fight over price discovery and price floors, and paper markets are still the battlefield. At some point, we have to accept reality. Paper silver sets the price, not physical. Almost all exposure lives in derivatives. Silver is priced via margin requirements, not scarcity. If pricing suddenly flipped to physical only, banks and brokers would collapse overnight. That's the system we're in. Miners are worth watching here too. They're down. but less than silver. They never ran as hard on the way up, and they're arguably more undervalued now than they were 4 years ago at $25 silver and $2,000 gold. Current prices still don't reflect anything close to $50 silver, let alone more. And zooming out, the bigger picture hasn't changed. David Hunter has been calling for a melt-up in gold and silver for years. His 2025 targets were hit. He's now raised short-term targets to $6,800 gold and $180 silver, with long-term projections still at $20,000 gold and $500 silver. This move doesn't invalidate the bull case. It confirms it. What we're seeing is a painful correction driven by leverage, not fundamentals. It may not be over. Corrections rarely end cleanly. But structurally, this still looks like the early phase of a long-duration bull market, one that's going to test patience before it rewards conviction. That's where we are.